Welcome back, everyone, to Let's Talk Business South Carolina. I'm your host, Rick Jenkins, and welcome. I am glad you're here. I am here with my next guest, Jeff Froman. Jeff joins me from time to time. He is a financial advisor and a certified financial planner for Thompson and Froman, which is an advisory practice of Ameriprise Financial Services. Jeff, welcome to the show again.
Thanks, Rick. I love coming back.
Well, I'm glad you were here, and as I told the folks before the commercial break, and I'll say again, if you guys recognize Jeff's name, it's because on every episode he does provide what we call a pro tip, 60 seconds of advice on wealth management, retirement advice, that type of thing. And you know what? The last one, or the second to last one that you did, you came to us from, were you in at the time Italy or France?
At the last one, we were in Nice, Italy.
Yeah.
Or excuse me, Nice, France. Yeah. The previous one was Lucca, Italy. So yeah.
Lucca, Italy.
Yeah.
Sounds good. It was Luca Brasi, right?
I don't know that one. But Lucca is the walled
Luca
city.
Brasi, he's the character from Godfather.
Oh, yeah.
Yeah, okay.
Gotcha.
Luca sleeps with the fishes. I don't know what that has to do with anything, but it was really cool to see you with that background. It looked absolutely gorgeous. How long were you over there?
We were there for 2 weeks.
You and your wife, Cheryl?
Yes, me and Cheryl. And we were visiting our daughter, Georgia, who lives in France, has been there for 8 years now. She's never coming home, sadly. But so we're going there next year for her wedding. So.
Oh, my goodness. Yeah. Well, it looks gorgeous. It looks beautiful. But welcome back to the States.
Thank
Good
you.
to have you here. Let's talk business.
Sure.
Interest rates, they're kind of high. What are they now?
The federal funds rate is 5.25% to 5.5%. So you're looking at 30-year mortgages that are over 7% now. Yeah. So then credit card rates are just going through the roof. My own credit card rates are going through the roof.
Right. And what are those rates of now? Well over 20?
Yeah. I mean, it depends on your credit rating, but anywhere from 18 to 26, 27%.
Right.
Yeah.
Now, if you are a homeowner, or if you are looking to buy a home, and you go out there and you get a rate at 7.2%,
right?
And a year and a half ago, you probably could have got it at 4.6%.
Yes.
A 2.5%-ish difference makes a ton of difference.
It does.
When that 30-year mortgage is all complete. I've looked at it before, and I don't remember, but all I know is it is a lot of money. So what do you tell would-be homeowners these days?
Well, there's a couple of things. It's like if you're in the market to buy a home and you can wait, you should probably wait. We totally expect interest rates to moderate late next year, so you might be able to get that 30-year mortgage rather than at 7.25%, 7.5% now. By this time next year or end of next year, it may be down around 5%. So
that's a humongous.
It is. It's a huge difference. I mean, the other option you have is if you really need to get in a home now, or you've finally found the home in your dreams and you're afraid to lose it, you can buy down that interest rate by paying points on the interest and reducing the rate you're paying. Now, that's a great thing to do if you're going to really stay in the house for a long time, because the payback on that buy down in interest rates is about 15 years, about halfway through the 30-year mortgage. So if you're really going to stay in the home, buy down the rate. If you're not, you should probably wait.
Well, if you had to have a home right now, wouldn't it make more sense to go on and buy it and then just refinance it a year from now?
That's always an option. Another option is an adjustable rate mortgage. If you believe that interest rates are going to fall over the next, 5 to 7 years. They always
make me nervous.
Yeah,
I got to be honest.
I've had a couple of them, and one worked out, one didn't. But but you can with a 5 or a 7 year ARM, you start out at a lower rate, and you can always refinance later. Of course, you have to take the risk that you're still going to be able to acquire that mortgage when you want to refinance. Are your numbers still good enough?
Yeah. Well, I am going to pass your advice on to my daughter in the way of sharing this link with her. My daughter graduated from college here recently, and she is a nurse over in Greenwood at Self Regional, and she was wanting to buy a home, and we told her now is not the time, but she's going to be glad to hear that a year from now, Jeff says all will probably be well.
Yeah, it won't. I don't think it'll be back to what my current mortgage rate is at when I refinanced back in 2018. But It'll be much lower than it is now.
That's good to hear. Tell us some things that people can do right now to positively impact their pocketbook, or just to cut down on the negative
Sure.
impact that's potentially happening.
Yeah. Now you got to remember that the interest rates are going up because the Fed is trying to push down inflation. And the way they do that is by reducing demand, basically making it more expensive for y'all to buy things. And they're having success with that. So there's 4 or 5 things that you can do. Number one is you can save instead of borrow. So if you have purchases out there like your daughter, and she's got that down payment, rather than going out and getting a mortgage and borrowing money now, put that down payment to work in a CD or a money market. They're paying huge yields now, 4, 5, 6% you can get out there. So in a year from now, she'll have 5 or 6% more to put down than she has now. So save instead of borrow. Another thing you can do is consolidate some of those high interest rate credit cards into a lower interest rate loan. If you own a home, maybe getting a home equity line of credit or a signature loan. But there's plenty of companies out there that do that, consolidating debt into a lower interest rate. And then strategically paying off debt. Pay off your highest interest rate cards first. Get those down as fast as you can. And then postponing, new debt, like purchasing a home or a car. Wait till the interest rates come down. And then finally, and this is a little counterintuitive, looking at establishing new lines of credit. If you have an asset that you don't want to sell, but you need to raise cash, you might want to go ahead and get a home equity line of credit for that cash need now if you believe that asset that you would have to sell is going to be worth much more in the future, more than the interest you would pay now. Mm-hmm. So it's, there's ways that's a smart way of using credit. But those are some things you can do to help fight the climate in rates.
From your chair, what does inflation look like these days? It's been coming down.
And our chief economist, Russell Price, still believes that it's going to continue to trend down. We're at about a 3.7% core inflation, which is what the Fed looks like, excluding food and energy, because they move around a lot. We believe it's going to come down to around 3.5% by the end of this year, inflation, and then probably close to the Fed's target of 2% inflation by the second half of next year. So we're trending in the right direction. We believe we're going to continue to go that way.
Don't anticipate any more increases?
Things can happen, but they would probably be things that would be transitory. If we got another spike in energy prices, oil goes up, gasoline prices go up a bunch, then yeah, we could get a transitory bump back up in inflation, but the trend is going to be down because the Fed is doing a good job of killing demand, basically.
I would assume if something unfortunate happens with Iran in the Middle East these days, that there could be some impact.
Sure. I mean, there's always those black swan events out there. I mean,
that's good.
Yeah. The thing you got to remember is those things tend to be transitory. What's going on over in Israel is heartbreaking. But it is transitory. And so the markets are currently looking through that, believing that it's not going to last all that long. So, yeah, there's a lot of things that could happen. A government shutdown could happen in the next 6 weeks. Mm-hmm. If we don't have a Speaker of the House and get a whole bunch of funding bills passed, we could have a government shutdown. And the Fed could decide that they need to raise interest rates more. So, we could have right now we don't believe there's going to be a recession, but if the Fed makes a mistake and pushes it too far, we could have a recession. If it's deeper than we think, that could be, bad for the economy as well. Absolutely.
Certainly. Other than a government shutdown or other than things going south, even further south than they are right now in the Middle East, do you see anything else that could negatively impact what's going on?
Not really. I think the reemergence of inflation and everybody's watching the Fed. As interest rates come up, the markets are pulling back. That's what we saw in August and September. It was all completely a reaction to interest rates rising. So that is what the markets are really watching right now. Of course, we're coming into earnings season. Right now, we're expecting the earnings to be, they're going to, year over year, they're going to be, there's a decline, but they've been improving over the last 2 or 3 quarters. So we're expecting those earnings, corporate earnings, to continue to improve. And we see the possibility that next quarter there will be positive, year over year earnings growth for corporations. So right now, we believe that going into the end of the year, we have it's a pretty fair chance that we're going to end the year higher than we are now. And then going into next year, things should continue to improve.
Fingers crossed, right?
Absolutely. Mine are crossed. Both.
Both of them. It's good to see you, man. Folks, that is Jeff Froman. He is a certified financial planner for Thompson Froman, part of Ameriprise Financial Services, wealth management extraordinaire. Jeff, appreciate you joining us, and also Mark for joining us a little bit earlier. That concludes another episode of Let's Talk Business South Carolina. Appreciate you joining us, and we will see you next time.